We're still on your modes of acquisition of property, plant, and equipment, and we are still in your initial measurement of property, plant, and equipment. So aside from PAS 16, we talked a while back with PAS 20, which is your government grant. So another mode of acquiring your property, plant, and equipment, which is measured under PAS 16 and under your initial measurement, is your self-construction of a property, plant, and equipment. In a self-construction of property, plant, and equipment, we also talk about one particular standard, and that is your PAS 23, which is known as your borrowing cost. So in this particular session, we are now talking about your self-construction and your borrowing costs as a mode of acquisition of property, plant, and equipment. So we talked with PAS 16 vis-a-vis PAS 23. So what is a self-construction of property, plant, and equipment? So this acquisition, aside from purchasing it outside, so instead of purchasing it outside, you create your own property, plant, and equipment. Self-construction. So in your self-construction of your property, plant, and equipment, you incur interest costs. You incur interest costs. So generally, in self-construction, you incur these two costs: your cost of construction plus your capitalized interest. Your cost of construction is known as your direct material, direct labor, and your overhead. So whatever is the direct material, labor, and overhead incurred to create or construct the property, plant, and equipment is your cost of construction. We will mainly discuss what is a capitalizable interest under PAS 23, or known as your borrowing cost. Sometimes capitalizable interest is also known as your capitalized interest or your avoidable interest. So why do we say it is capitalizable interest or capitalized interest or avoidable interest? You know that if ever you have an interest expense, it will be placed under your profit or loss, particularly expense. So why do we say it is capitalizable or avoidable? So instead of placing it as expense, we place it as part of cost of the asset. So we capitalize it. So we place it as part of the asset instead. Therefore, we avoided an expense, but we have an asset. Okay? That's why it's called capitalizable or avoidable. We avoided an expense. Instead, we had an asset. Okay? So normally interest is an expense, but it's called avoidable interest or capitalizable interest or capitalized interest because we place it as part of cost of the asset. So as you can see, how do we measure your self-constructed asset? Initially, cost of construction plus capitalizable interest. Now we go and dwell into your PAS 23, which is your borrowing cost. Your borrowing cost, before we can particularly capitalize, you must first define a qualifying asset. So PAS 23 defines what is a qualifying asset. So what is a qualifying asset? A qualifying asset is an asset which require a period of time to be prepared for use, qualify for interest capitalization. So a qualifying asset, so long as there is a certain period of time to prepare that particular asset for its intended use, and you incur interest while preparing that asset, we call that a qualifying asset. So you prepare that asset. Aside from preparing that asset, you incur interest. Okay? So your preparing is, of course, your self-construction. Your interest is known as your capitalizable interest. That is your qualifying asset. But of course, what we need to learn here is when do we capitalize your interest and at what particular amount should we capitalize it? When do we start? When do we end your capitalization? When do we cease? When do we suspend? So we need to know those items under PAS 23. And under PAS 23, your capitalizable interest is commenced, meaning we start capitalizing interest if the following are present. Remember, interest capitalization begins if the following are present. So when we talk of commencement, when is the start of the capitalization of your interest? So all of the three items must be met. The first is the expenditures for the asset have been made. So if you are constructing an asset, there should have been an expenditure that is already used to purchase, or there is already an expenditure that is made so that you can already create or commence constructing your asset. Another, your activities necessary to get the asset ready for its intended use are in progress. So instead, or aside from your expenses, you must also start constructing. And lastly, your interest cost is being incurred. This is one important thing. Okay. So aside from uh, creation or particularly building your asset, you must earn interest. As we said a while back on the definition of a qualifying asset. So when do we commence capitalization of your interest? If the expenditures have been made and acts necessary to finish or create that asset had been made, also interest cost is being incurred. Next question is, when do we suspend capitalizing interest? So we said we start if the three items are present. Next question, when do we suspend? We suspend only during extended periods in which active development is interrupted. Take note, extended periods, okay? Not necessarily short period, extended period. So for example, you construct, there is a typhoon for 3 days. So you construct, typhoon happened. So within that particular date of typhoon, you were unable to construct. Question, during that 3 days, will you suspend? No, that is only a short period. There must be an extended period. Okay? So when we say extended period, you really stop constructing. So, for example, you are constructing for a building, you stop constructing for 3 months. That particular 3 months is considered extended period in which the development is really interrupted. So, if ever it is really a short period only, then you do not suspend. Next, when we already know when to start, we already know when to suspend. When do we cease or when do we end the capitalization of your interest? The capitalization of your interest should end, of course, when it is substantially complete or when it is complete. Of course, you end capitalization once the asset is already intended for its particular use. So once it is already complete. So when it's the start of your interest capitalization at the start of your construction together with your interest cost. When can you say that there is a start of construction? If ever expenditures have been made and activities have already started. Plus you incur interest. When do you end? Of course, when the construction is already complete. Therefore, guys, past 23 is always connected to your creation of a particular asset. That's why we place past 23 in your modes of acquisition of property, plant, and equipment. What is the mode here? You will create or self-construct a asset, an asset. So in creating an asset, you incur interest. In creating the asset, you incur interest. So what do we call that asset that you create again? Qualifying asset. What do you need to learn in your qualifying asset or your interest capitalization? So you must learn when to commence, when to suspend, and when to cease capitalization. The next question is, what amount of interest should we include? What amount of interest should we include? So when we talk about your amount of interest to be included, that is your capitalizable interest or your capitalized interest or your avoidable interest. So those are the terms that we talk about if ever the question is what amount. So what is the capitalizable interest? What is the capitalized interest or what is the avoidable interest? So your capitalizable interest depends whether it is a specific borrowing or a general borrowing. So what is a specific borrowing? This is a borrowing specifically made for the construction. So in short, you borrowed for the construction. General borrowing, you have borrowings that is existing during the construction but not specific for the construction. Okay? So meaning it is a borrowing for general use. For general use. This is specific borrowing for a specific use. And what is that specific use? That is for the creation of the asset. You borrow for the creation of the asset. So what amount? For a specific borrowing, we just get the actual interest less any income earned. Actual interest less any income earned on that borrowing. Sir, what is that income earned? Normally, we have excess amounts out of that borrowing. And that excess amount is reinvested. So if we reinvest that excess amount, we call that income on that excess amount as income earned. Sir, how do we compute for your actual interest? That is equal to the face of the borrowing multiplied by your interest rate multiplied by your period. Okay? So whatever is the borrowing, so let's say you borrowed 10 million for the particular capitalization or for the creation of that particular asset. So that is the phase of the borrowing. If the interest rate is 10%, then 10%. And the period, let's say, the period of your commencement until the cessation is 8 months. So 8 over 12. Okay? So the period talks about your commencement until your cessation or the start until the end of your construction. And what if it is a general borrowing? So if a general borrowing, that is a borrowing that is for general use. So it is only existing, but it is not really for the construction of the asset. So first, we need to get for our general expenditures. So what is your general expenditures? Your general expenditures or your general average expenditures is equal to your expenditures multiplied by your months outstanding. For the purpose of this discussion, I will not talk about how to compute for your average expenditures. But again, you just need to compute using your months outstanding. If you still remember your partnership accounting, wherein you compute for your weighted average capital, okay. If you still know the concept of computation of your weighted average capital, it's the same with the computation of your weighted average expenditures. So your expenditures, you multiply them to their weight. What is the weight again? Depending on your months outstanding or months unchanged, if you still remember them in your partnership accounting. You multiply it to your general borrowing rate. What is your general borrowing rate? This is the average interest rate of the general borrowing. Average interest rate of the general borrowing. So if you have different general borrowings, so for example, we have here 10 million, 10%, 5 million, 8%, 3 million, 12%. Okay, you get for the total interest first. So what is the total interest? So the total interest is equal to 10 million times 10%. That is 1 million. 5 million times 8%, that is 500,000, 400,000. And then 3 million times 12%, 360,000. So 1 million plus 400 plus 360, 1,760,000. And the total fees is 18 million. So when we talk about your capitalizable interest as a general borrowing rate, you get the average interest rate of the general borrowing rate. That is equal to your total interest divided by your total fees amount. So what is the total interest that we have computed? 1.76 million. What is the total fees amount? 10 million, 5 million, and 3 million. So that is 18 million. So 1.76 million divided by 18 million, our interest rate is 9.78%. So that is known as your general borrowing rate. That is the average interest rate of the general borrowings. So first, you have your general borrowings. You get for the total interest. Total interest divided by the total face amount will give you your general borrowing rate. But before you capitalize, your capitalizable interest must not be greater than actual interest. Okay? So For example, our actual interest should only be 1.76 million, di ba? Because that is the amount of the total interest we have computed. However, once you use this, your total capitalizable interest now becomes, let's say, 1.9 million. So this is your computed capitalizable interest. You compare it to your actual, which is 1.76 million. Whichever is lower, that is your capitalizable interest. Because capitalizable interest must not be greater than the actual interest. So if you computed this one, and this is your actual interest, whatever is lower, that will be your capitalizable interest. So always compare your computed interest to your actual interest. Again, you already know when do you recognize the capitalizable interest, when to start and when to end. Your next question under past 23 is, at what amount will you capitalize the interest? It depends whether the borrowing is a specific borrowing or a general borrowing. If it's a specific borrowing, you just need to get for the actual interest, that is space of the borrowing multiplied by interest rate multiplied by period, less any income earned out of that specific borrowing. But if that is a general borrowing, you still need to compute for your general average expenditures. So how do we compute for your general average or weighted average expenditures? Just like how you compute for your weighted average capital in your partnership accounting. Next, you compute for your general borrowing rate. That is equal to your total interest divided by total face amount. That is your average interest rate out of the total general borrowing. That will give you your capitalizable interest. So capitalizable interest, as a rule, should not be greater than your actual interest. So always compare your computed interest to your actual interest, whichever is lower, that is your capitalizable interest. Okay. Now, maybe at the back of your mind, you're asking, sir, there can be a chance, is there a chance that we have both a specific and general borrowing? What if we have a specific and general borrowing? What is the treatment? So first, you get for your average expenditures less specific borrowing, whatever is left to general borrowing. So this is specific borrowing, you multiply it again to your rate, you multiply it to your period. Your general borrowing, you multiply it to your general borrowing rate, you multiply it to your period. Okay? So if there is a combination of specific and general borrowing, you get the average expenditures, and then you apply first to specific borrowing, and to general borrowing. Okay? So that's how you will apply it if in case it is a combination of specific and general borrowing. Okay, let's wrap up path 23 or your self-construction of asset. So under path 23, it only applies if it is a qualifying asset. So when we say qualifying asset, it takes substantial time to create that asset. So if we incur interest costs, then we can capitalize. So the first question is, when do we commence your capitalization? We have the three items again. First, if expenditures have been incurred. Second, activities have been started. And interest costs have been incurred. Next, when do we suspend? During only extended periods of active development, which is suspended. And then lastly, we have your cessation or the end of our capitalization. When do we end? We end when it is already complete or substantially complete. And then lastly, what amount? So the amount is dependent whether we have a specific borrowing or general borrowing. Take note of the rules on your specific and general borrowing, but also take note that the capitalizable interest should be the lower between the computed interest and the actual interest. So always compare that. So can we combine both specific and general borrowing? Yes, we can also combine them. So that's it for another mode of acquisition of property, plant, and equipment, which is under your self-construction, wherein we talk also about your past 23 borrowing costs.